Over the last 8-9 years, High Alpha has launched about 40 companies. Our average age of our founders is probably 45.
Venture Studio High Alpha launched High Alpha Innovation, a studio working with corporations.
One of the questions we wanted to answer with the launch of High Alpha Innovation was, what does it look like to scale a studio model? And we started partnering as an experiment with corporations and realized pretty quickly there was a big opportunity there. In the last 2.5 years, we've launched in High Alpha Innovation close to 20 companies. Studio and its portfolio companies has raised over $500 million. External startups can learn and do things in a way that a large corporation that's optimized for scaled execution cannot. We don't manage a fund at High Alpha Innovation. We're mostly launching software companies and mostly B2B software companies. These are startups that immediately have first customer. I think a lot of studios underestimate just how hard it is to work with corporations to build new startups. We like to do things that work.
We've hosted already 5 online conferences for venture studios, VCs and family offices, and I'm inviting you to join our paid community called Venture Studio Family. If you are a venture studio founder or a representative or a manager of a venture studio, you want to learn the best practices and know how different venture studios operate. So you can find the best ways on how to attract founders, great founders to venture studios, or how to create successful companies with not superstar founders. You can learn how to fundraise into your studio fund, or into your startups created in the studio. You can learn how to create sustainable studio which has cash flow and which can be not dependent on external venture capital. You can find the best ways to manage the studio if you join this community. So check the link, Venture Studio Family, in the description and join the community of about 30 venture studios.
Great, Elliott. Nice to meet you and nice to talk to you about High Alpha Innovation. Can you start with High Alpha and then tell about how you decided to create a High Alpha Innovation inside, and like maybe a bit about your path, entrepreneurial, advising and building, creating ventures?
Yeah, happy to tell the whole story. So High Alpha began in 2015 as a venture studio in Indianapolis. It was founded by 4 friends who had been involved one way or another in the launch, scaling, and ultimately the exit of a company called ExactTarget that was sold to Salesforce in 2014 for $2.5 billion. And they launched High Alpha in Indianapolis out of a desire to go build more companies. They saw the kind of the magic that ExactTarget created in the ecosystem and what it did for the people who were involved, and wanted to go do that again. And so I came up with this idea to build a company that could launch more companies, and called it a venture studio. It's a term that has caught on since then. Over the last 8, almost 9 years, High Alpha has achieved quite a bit of success. Initially, it was going to be just a team of people to build companies. Investors suggested that High Alpha also ought to have a venture fund to put capital into the companies that the studio launched, as well as other startups. And so High Alpha began as a venture studio plus a venture capital fund, or a startup studio plus a fund. That's what we define as a venture studio, that combination of a build team plus capital. Over the last 8-9 years, High Alpha has launched about 40 companies. High Alpha has invested out of its fund in a number of other companies as well, maybe 100 or so deals over time. I joined in 2018. My background is in corporate innovation strategy. Spent many years working with a gentleman named Clayton Christensen, who was one of the big thinkers around innovation, how that works inside of organizations. Worked at his consulting firm called Insight that he started. Also worked in launch companies and things myself over the years. Joined in 2018. A couple of the founders of High Alpha were old friends of mine. And initially, I joined to work in the studio to work with the founders of High Alpha to generate ideas, to come up with a systematic way to make sure pipeline of ideas was steady and that we were launching a good number of companies. And I joined just as we were launching Fund 2 back in 2018. We launched another 17 companies or so in Fund 2. And one of those companies in early 2020 was High Alpha Innovation. So what happened is we were having a lot of corporations reach out to us and ask if they could learn from our approach. They were contemplating either building their own venture studios or doing venture building in one way or another themselves. And we started partnering as an experiment with corporations and realized pretty quickly there was a big opportunity there to take this playbook we had developed for systematic venture creation and to make it accessible to corporations, ultimately to universities and even government entities now as well. So that's how we began. Early 2020, spun out with a couple of people. There were 3 of us initially. We scaled the business to be about 40 people in total. In the last 2.5 years, we've launched in High Alpha Innovation close to 20 companies. We hope to launch as many in the next 18 months. Increasingly, our work we started out working exclusively with corporations. Can explain why that is, if you'd like. Over time, we've had more universities reach out to us as that's become an important part of what we do too, is working with universities to help them create successful startups out of their ecosystems.
Yeah. So about High Alpha, can you give an understanding of how is it structured in terms of like there are funds where you invest money directly into startups, created or external startups, but do you have some additional fund, which is like for the venture studio itself or a startup studio? Like, can you describe this?
Yeah, so I think High Alpha may have been the first to develop that dual entity strategy that a lot of studios use now. One of the first. In some ways, kind of stumbled into it, and it had something to do with the way that High Alpha got started with the idea initially that there'd be a company building companies, and there were different investors interested in participating in that vehicle. And then one group of investors suggested, you should have a venture fund too, and we'll seed the venture fund, let those other investors do the studio. And so High Alpha was set up initially with two funds. One was a studio fund, one was what we call our capital fund, which is venture capital, and that structure has stuck. High Alpha is getting ready here soon to move to Fund 4, both on the capital side and the studio side, and you've used variation of that approach ever since.
If you can share some numbers on like amount of this funds of High Alpha, would be interesting to know, especially like comparison of this like studio funds and capital funds.
Yeah, to date, Studio and its portfolio companies has raised over $500 million. The current fund, next fund, are on the capital side north of $100 million with the Studio. Being a much smaller fund relative to that, in the neighborhood of, I'd be guessing, probably out of turn what the current fund's going to be because I'm not affiliated.
$5 billion, it is all amount of funds raised for investing into companies, right?
That's all the funding raised into the studio funds as well as the companies that have launched out of the studio.
You plan or you have some projects now when you will launch a studio for corporations, right?
Yeah, so we began with the idea that we're going to just team up with corporations and universities, run one-off sprints, and we'll go launch a company or two. But over time, if that's working, some of those corporations and universities would want to build and partner in a studio with us. And we're now at the point where we're launching studios.
And you will stop doing just separate?
No, I think that will always be part of our approach, actually, because it's a way for new corporations, universities to try this model.
MVP.
Yeah, kind of. Yeah, if you think about it, for us, it's top of funnel. Our ultimate goal, the most efficient way that we know to build startups is in a studio model, and doing a one-off 2 times building startups with a corporation is really inefficient in the beginning. The 10th time you do it is a lot easier than the first time you do it, both for the corporation and for us. And so the goal is to enable people to try out this approach, to see that it works, to test us out and for us to test them out. And if we all work well together, move to a studio model where we can go build a broad portfolio of startups that help them achieve whatever their objectives might be for that.
Can you name maybe one the most successful company in high alpha innovation, and also fail or problem with the corporation, and just describe like what was the mistake?
No, yeah, I'll do the latter without naming any names probably. But our in terms of companies doing well, we've got a number. It's like they all feel like our children. We are co-founders in all of them, and excited about what all of them are doing. We have some that are a little further along. To give you a good example of this, the first company we launched is a company called Amplio. We launched it in cooperation with a business called Koch Industries. And Koch Industries was dealing with some supply chain challenges in their business at the time, in particular, having a hard time looking at the kind of static supply chain risk in one of their businesses. And it contemplated building an internal tool to solve the issue at great expense. And we thought that if they had that problem, maybe others did too. Went out and validated that, yep, a lot of companies had that same problem, and that we could build a startup to solve it pretty efficiently. Went out, launched a startup, designed the business model, launched the company Amplio, recruited 2 amazing founders to run the business with experience in the space, building startups. They started working with Coke as a first customer, building a tool. Very quickly realized that there was a bigger related opportunity to enable these large companies, these electronics manufacturers they were working with, to buy and exchange parts, and have pivoted over time somewhat to a marketplace model, which is a big deal. Amplio raised a really successful venture round 12 months after launch to the day, actually, with some tier 1 VCs came in at a really good valuation. They're crushing it. That was an example of a corporation having a core business problem they couldn't find a good solution for. And we built a solution as a way to bring that capability into the corporation. I mentioned Atheon's another one that I think is doing really well. Atheon is a company we launched with a corporation called Elanco. Elanco makes animal pharmaceuticals, and we looked at their commercial animal business. So think of dairy and cattle operations, and found that there was a need for a business that could come in and do carbon validation and create a marketplace for trading of carbon credits for those particular users, and in particular enable dairy farmers and cattle farmers to do insetting to get credit for changes they were making to their business processes that were good for the environment. And Atheon launched and immediately went out and raised $5 million from other big industry players who decided to adopt Atheon as the industry standard for their customers and other stakeholders. As a result, Atheon's gotten tremendous traction and attention in the space because of that. So that's an example where something clearly needed to exist in the ecosystem. If any one corporation went out and built it, others wouldn't participate. But by doing it in an independent startup with investment from these corporations, Atheon immediately started achieving some success and resilience. There's a couple examples, but many more in the portfolio. We've got a lot. Our founders are amazing, doing incredible work. You asked about kind of the failure modes. When it breaks down, it's interesting. We started back in 2020. Our first year, we actually didn't launch any startups with corporations that first year. So what we learned how to do was run these sprint cycles and to work with corporations, but no startups resulted immediately. We began launching startups in 2021. So there was a kind of a lag time. Many of those corporations we worked with in 2020, it turned into startups in 2021, but it took longer than we thought it would initially. In 2020, we were kind of just learning how to engage with corporations. 2021, we began building startups. 2022, we began building startups at scale, launching a lot more. In 2022, we launched 11 or 12 companies. 2023, it was about continuing to launch companies, but also now building the studios and funds that we manage. And next year for us is about going much deeper into studio operations with partners and more funds under management. The early days in 2020, why did some of those partnerships not result in new companies? I think our team, we just had a lot to learn about how to to work with executive teams to get them comfortable with the idea of launching external startups in which they had a minority stake. There was a lot we had to learn about how to best structure the deals, how to design the cap tables, how to make sure that these things, everybody benefited. It just took a while to learn. And we learned, in some cases, the hard way. So I don't know that there were failure modes that, more than anything, were just out of lack of knowledge or experience collectively on our part of our partners who hadn't done this before, too. We've learned a lot since then. Now, when we run a sprint with a corporation, even if it's the first time, almost every time a startup results, at least one startup results. Yeah, we're pretty guarded about the specific numbers because of the sensitivity around that with many of our partners. But what I will say, as mentioned, we've launched close to 20 companies in the last 2.5 years. We hope to launch 20 or more in the next 18 months. And if we continue on track, we expect that we'll launch 500 or more companies in the next 10 years. And it's not a matter of that sounds like a lot of companies, but I actually think if we do things right, if we just continue doing what we're doing and growing at the scale we are, we'll launch far more than that, actually. In that portfolio, we hope will become the world's most valuable venture portfolio. So that's kind of what we're on a path to do. That's our mission. We're pretty serious about it. So far, so good. We are on track. It's early days.
Some more question, like what is size of your team in High Alpha Innovation? What is your team?
Coming up at close to 40 people now. About 40 people.
So then like 1 to 2 million is average investment of your partner. So getting from, I don't know, what is average, like 20, 29%, this range?
Yeah, for our partners. Yeah.
You said valuation on start. So during incorporation, what is, so it's like, I believe something like 5 to 10 million.
Correct. Yeah, at launch.
Maybe you have some figure you can share, like what is total money attracted by your companies?
Yeah, to date, total capital raised into High Alpha Innovation startups or the funds is probably around $50 million.
$50 million. Including those initial investments, right?
Yeah, including the initial investments, north of $50 million. I should know the exact number to that. I don't know the exact number. It's not something we track carefully. We're more worried about just launching companies and see what happens. Right. But knowing that the portfolio is increasing in value, we probably raised north of $50 million. When you think about the studios and funds that we're currently raising capital for, it will soon be significantly more than that.
If you have a number of total revenue of your portfolio, annual, probably B2B SaaS, right? You are doing together.
We don't actually track that at a portfolio level. Maybe we should. It's not a metric we keep track of. We do track overall portfolio value, which is increasing pretty dramatically. The most important metric in our studio is just the number of companies that we're launching, knowing that each one has a present value that's pretty significant. And so we don't worry too much about tracking the numbers apart from
But valuation, if you can share valuation of the portfolio, would be interesting.
I don't actually know the number.
That maybe also valuation of the portfolio, yeah.
Yeah, that maybe tells you something about the way that we manage our studio.
By number of launched companies, yeah, I understood.
Number of launched companies, yeah. The results will take care of themselves over time. And so we don't fuss too much with the valuation at any given moment. The results will take care of themselves over time. And they are.
Can you tell more about High Alpha Innovation in terms of like what is business model with corporations? What is usually equity split when you attract some founders and then take money from corporations who invest money and your studio helps to launch startups. So like what is equity splits and how does it work usually?
Yeah, it's a fairly complicated business model. So as I'm explaining it, you tell me if it doesn't make sense and I'll try to clarify. Let me explain why we do it, why we began, why we were interested in working with corporations at all. There's kind of two primary reasons. One is what the corporations need, and number two is the benefit that it brings to us. Corporations, it is much harder to innovate than it used to be for large organizations. There are a number of interesting reasons why that is true. But the data tells us without a doubt it's gotten harder for large corporations to innovate. We see that in their the way that their lifespans are shrinking. It's harder for them to keep up with the market, to innovate faster than the market does. And corporations, the traditional pathways through which they access innovation, M&A and internal R&D, partnerships and venture investing are all really good tools, but they're all less effective than they used to be. Again, a number of reasons why that is so, but corporations need to be trying new things. And our view is that ventures, especially independent external startups, can learn and do things in a way that a large corporation that's optimized for scaled execution cannot. Corporations are built and designed to be safe and predictable. Innovation requires making mistakes, being unpredictable, and being capital inefficient. Startups, funny enough, they're optimized to be capital inefficient, but actually to learn really quickly too. Now, over time, startups have to become capital efficient, but in the beginning, their job is to learn, to discover business models that work and to figure out product market fit. So our thesis is that corporations can tap into innovation, certain types of innovation that would be hard, through the creation of independent startups, and in particular, independent startups in which there are other participants and part owners, to ensure that those businesses are protected from the core business of the corporation and can produce the surprises that the corporation needs to be able to tap into new S-curves of growth over time. Mm-hmm. So that's why it's good for the corporations, why they work with us. Number two, why it's good for us. We believe that if we can successfully launch startups with corporations, universities we can talk about too, if we believe we can launch startups with corporations where those corporations are our first customer, a distribution partner, or in some way providing some type of advantage, including credibility to that young startup, that startup is more likely to succeed than your average startup in the market. And we've seen that to be true in our portfolio. We believe that the companies that we launch are by and large much more likely to get to bigger outcomes and to achieve those outcomes faster than if you and I were to go launch our own startup without the help of a big corporation. Now, there's a lot embedded in that around how we structure the relationships, the cap tables that matter to make that work. In terms of how our business model works, we don't manage a fund at High Alpha Innovation. And we do that. That's a deliberate strategic choice, which I can explain to why we've opted for that path. But we don't manage a fund. Very unlikely that we ever will. Rather, what we do is we partner with corporations and universities and effectively rent out our team to do that early work of business model design, where we'll source problems. We've got a process we run through. We developed at High Alpha, looking at themes, identifying new opportunities or problems to solve, designing business models around those, validating those business models, and getting businesses ready to the point where they're launchable as new ventures. For that, we rent out our team to our corporate university partners to work with these experts. The corporate university partners pay us for that work. Once we decide to launch a business, from that point on, we don't get paid anymore for the work that we do. We'll launch the companies. We'll take a minority equity stake in those businesses alongside other investors, corporate innovation, corporate university partners who are participating, the founders we bring in. And we will set up the company, all the nuts and bolts part of the typical things a studio does to incorporate the business and set up the payroll and benefits, build the website, design the product, all those things initially. Over time, where we focus, we recruit founders to run the company full time and work alongside those founders to help them with recruiting, to help them make sure they're getting traction in the market, building a good product, and they're able to sell that product to customers, and then helping them with their fundraising strategy. Our goal is to make sure that those businesses at least get to a successful seed round, usually about 12 months after launch. Now, in terms of the cap table split, which you asked about, our goal is that the founders we bring into these businesses own at least 51% of the company between the founders and the pool for new employees who come in. We found that to be kind of the sweet spot that balances the interests of the initial investors and the investors we want to recruit later, form of venture capitalists and other investors who might come in 12 months and beyond after the launch of a company. We generally take about 20% in those companies when we launch them, and the rest goes to the capital providers, which in most cases are the corporations or the universities we work with. Not always. Sometimes that money comes from other investors as well.
Can you tell about the business model? Like, is High Alpha Innovation a sustainable company which doesn't need investments and you cover your expenses by services provided to corporations and they pay for your work? Or how is it?
Yes, that's correct. Yeah, the business is sustainable based on what corporations and universities pay us to partner with us. I think our model is unique, maybe what some other venture builders and venture studios do, in that we exclusively focus on launching external venture backable startups in which the corporations or the universities involved have a minority stake, not a majority stake in the venture. I know a lot of other studios and venture builders have experimented, and as a way to fund their operations, they'll work with corporations to build internal ventures or to build external ventures in which the corporation has a majority controlling stake. Our team is pretty experienced in the world of corporate innovation. Many of us, half a dozen of us, worked with Clayton Christensen at his consulting firm. Many of us have been inside of corporate innovation teams in the past. And the reality is that most of the time, those efforts are unsuccessful for a number of reasons we can get into if you want. Probably a topic for another podcast, not this one. But we like to do things that work. That sounds harsh. Our preference is to build things that really do make a difference. And our belief is that the incentives matter a lot when you're building new ventures. And it's very hard to get the incentives right in which a corporation, again, that is optimized for predictability and safety and all these things. When a corporation has a majority stake in the business, that new venture is very unlikely to do anything that doesn't look like what the corporation is already doing itself. So there are plenty of situations in which corporations should build ventures internally or should build ventures in which they have a controlling stake. But those things tend to look a lot like what the corporation already does. And corporations, frankly, are well positioned to do that themselves, maybe with a little bit of outside help. Our view is that there's a lot more value to be created, both for the corporations and for us, if we focus exclusively on venture backable independent startups that we can build together with the corporations coming in, at least initially, as a minority owner, with the right, of course, to double down later and become a majority owner at some point in the future. But we want them to retain that optionality in the beginning, not to close the door to other investors or other participants from the get-go.
What are motivations of universities to launch companies? And like you partner with university and they have capital to finance. And what is usually like the amount of capital they invest? Something like pre-seed round up to 500K or more?
Yeah, universities, obviously different motivations than corporations. Corporations are trying to tap into innovation that will enable them to grow. They're trying to learn. They're trying to build optionality for the future. Universities, strong universities exist in strong ecosystems. And a lot of universities have as part of their mission a desire to build up the economy in the ecosystem in which they operate. They have a desire to see the research that's done at the university commercialized and turned into benefit for, in many cases, the taxpayers who are providing ultimately the funds for that research to happen. And we've been approached by many universities that have reached out to us saying, we launch a lot of companies out of our university. Too many of them fail, or they're not achieving the outcomes that we would expect. In fact, universities, by and large, are achieving lower success rates than average venture-backed startups, which is a remarkable thing to say. And so they come to us because there's a desire to, number one, to partner, to see if we can dial up the success rate of the startups coming out of the ecosystem. Number two, universities have a desire to provide more of a structure for collaboration between alumni, industry, university researchers, students. The venture studio model actually provides a pretty good structure for doing that, where alumni corporations can invest in a fund that is a for-profit investment, generating, sourcing ideas from industry, working with researchers who might have some ideas that would relate to those opportunities from industry, creating new intellectual property and building companies in a way that benefits everyone involved. So a lot of reasons why corporations or why universities are doing it. In some cases too, at least here in the US, there's the endowments at universities feel a responsibility for investing some of their funds in venture creation or things happening around the university that perceive to directly strengthen the university. A lot of times the pool of potential opportunities in which an endowment can invest is smaller than the endowment managers would like. So a venture studio is a good way to create more deal flow.
And what are checks invested by universities and corporations? Are they different?
Yeah, they're not actually. They're not different. Our view is that it depends on the market dynamics at any given time, but generally we're mostly launching software companies and mostly B2B software companies. And our current view is that typically those companies require at least $1 million in funding at launch. Sometimes 2 million, right? Sometimes more. At a minimum, the floor is $1 million investment. Again, our goal is to make sure that the startups we launch can get to a good seed round about 12 months later. A few years ago, companies could get to a seed round with maybe 100,000 in revenue, and we're finding in the current market that it takes more revenue and sometimes more time. So depending on the industry in which that startup's operating, depending on how long we think it might take to achieve the revenue markers that we need to hit to raise a good round, that determines the how difficult technology
$1 to $2 million. If you say like 51% to founders, does it mean that usually it is something like 25% or from 20 to 29% is going to a corporation? And the question here after this is, do you encounter obstacles in raising future funding for those startups if they see that already, or there are two players on the cap table with around 45 probably percent?
Yeah, it's a good question. Implied valuation at launch is somewhere between like $4 to $10 million, right? We don't generally think about it that way. We're thinking about what are the different inputs and what's a fair split of kind of a claim on the equity on the cap table, based on the relative importance of those inputs at the beginning. Knowing that over time, for example, if we start out at 20% and we're not investing capital, later on we expect to be diluted down and probably at a faster rate than the founding team involved in that company. What we do find with investors coming in is a mix of reactions. It depends on the investor and it depends on the state of the company that's raising capital. Obviously, the businesses that are performing really well and demonstrating traction, investors seem to be less worried about who else might be on the cap table. They just want to get into the deal. In other cases where that initial capital may not have been enough to achieve the traction required for good valuation, there's more compression, and rightly so, on the cap table. So it's a mix of reactions. There are, I think, a lot of investors who look at what we're doing, the idea that we're building startups immediately with corporations, universities helping in one way or another to make sure those startups are more successful. They see the benefit of that and are eager, in fact, in some cases, kind of anxiously waiting to see what we've got coming off our assembly line so that they can participate as investors. In other cases, there are investors who aren't comfortable with the venture studio model yet. I think in many cases, the investor reaction, that discomfort with the cap table, in many cases is just an easy way to say no. Where they don't have to say they don't like the idea or they don't like the founder. They can say, I don't like the cap table. It's an easier way to say no. Our typical response to pushback like that is to ask investors what they'd like the cap table to look like. What would they prefer the cap table look like? And let's talk about what we need to do to make it look like that. And we're usually pretty willing to work with investors who are interested in businesses if they're the right investors and we believe they can help.
Can you tell more about the differences of launching startups with corporations and independently in high alpha? So,
Yeah.
like, what might be obstacles when partnering with corporations, and what are benefits, and what is the difference? Because many venture studios around the world, they think like, do we have to partner with corporations or just launch our independent startups? And both models have some pros and cons, and it might be difficult to answer to this question. But you have both experience with both models, probably you can compare.
Yeah, definitely there are pros and cons. The doing it independently, obviously, there are no other decision makers in the mix. You can move really fast to start companies. The downside is it's harder to get, I think it's harder to get a deep understanding of the problems around which you want to design business models. It's harder to line up those initial customers because they aren't harder to align the incentives to make sure that they're motivated to see those startups succeed. On the flip side, launching with corporations, all of a sudden you've got all these people involved who have some rights over the decisions that get made, obviously. And the structure and incentives matter a lot to make sure everyone's moving in the same direction. We've learned a lot about that over the last several years, partnering with corporations, how to make sure those incentives are good for everyone. But I'm not going to pretend like that is easier. It takes longer. And I think we've got a very good process. We've seen a lot of pitfalls and traps and hard things that pop up when you're doing this as a corporation that we figured out ways to manage around, including the taxes and where the equity is held, all sorts of things that have popped up that we've learned a lot about. I do think our team is very, very good at working with corporations and helping them navigate this process. That ultimately is critical. Like they have to do it if they want to be successful at innovating over time. The benefit is that we are building startups that really are endowed with advantage. We call them advantaged startups, which sounds a little bit hokey, I will admit, but we believe in it. These are startups that immediately have first customer or first customers signed on, that have distribution partner, that have credibility in their industries, in a way that would just be really hard otherwise. So we're very, very appreciative of our corporate partners who are willing to go through this process with us. It's not easy. These corporations that are optimized for predictability, safety, for execution at scale, to go work in the creation of these baby startups that are very, very different and optimized for a completely different set of things, different governance, different incentives, different talent, different processes involved. It's a hard thing for these corporations to do, although a necessary one for them. And we're very appreciative for the corporations that partner with us in this work.
Do you have outbound offers to some corporations that you go at them and suggest that, you have, let's say, corporate venture capital, maybe we should start a company together, or they go to you?
Yeah, usually in most cases, corporations are coming to us. Something as broad as just help us, we need to be more innovative, or something like we're interested in this space, we need to get smarter about it, want to go invest in it, or we've got a business problem we can't find a good solution for and think a new startup could help, or our ecosystem needs a thing that a startup could do better than we can. Or it's a version of, sometimes we've built a thing inside the corporation and we think it might have more value if it were spun out as an early stage startup. Can you work with us to do that? Most of the time, that's how it begins. In some cases, we've got ideas about things we wish existed, and we go out proactively and identify good partners who we'd like to go build those businesses with and see if they will jump into the deal with us.
When they come to you, do they usually have some venture capital fund and investments, previous investments? Or like, what is the profile of those corporations? It might be an advice to some other venture studios looking to partner with corporations. Like, what is the profile of those corporations?
There's a few things we look for. Corporations that we engage with, we want to see that this is they've got support at the highest levels of leadership. It's a very hard thing to launch new ventures. If not done properly, it can feel like a massive distraction to the core business. And so we need leadership engagement. Related to that, there has to be a clear strategic rationale for why venture building matters to the future of the organization. Number 3, there needs to be at least a sense of where the capital is going to come from for investment into the startups. That doesn't mean they've got a venture fund necessarily. Sometimes they do. That helps. But there just has to be a sense of where that capital, where it's going to come from. If those 3 things aren't in place, our team is well positioned to work with a corporation to help put those things in place to make sure they can start building and doing it systematically efficiently. But that's kind of how we filter out who might be in a good position to do this.
You mentioned that you don't plan and you don't have a fund to invest in companies created together with corporations. Can you elaborate what is the reason?
Yeah, we've seen other groups run into challenges around this. There are conflicts of interest that pop up around you're on the one hand a founder of the business. This is true in any venture studio with a fund, but you're on the one hand a founder in the business, on the other hand an investor. So when that company's out raising money, the founder side of you wants that valuation to be as high as possible. The investor part of you wants that valuation to be as low as possible. That creates tension. That's manageable. That's not too difficult. Venture studios have navigated that pretty effectively. A dual entity structure we talked about helps in that. But when it comes to the way that we work, since we're not investing capital at the launch, any fund that we raise would be there solely for follow-on investment. There are a lot of days where I wish we did have a fund and could double down, take advantage of our pro rata rights as companies are going out and raising. On the other hand, it creates some difficulties. We might have a fund, for example. We decide that we tell our startups, we're only going to invest if you don't want to pick and choose those later rounds, which ones you're going to invest in or not. It's a complex issue. We might, for example, say, why don't you go, we'll match any dollars you get up to the first $1 million, and we'll be an investor. You can go tell investors that we're putting in $1 million alongside you. We've seen that done before in other instances, and if not managed properly, what happens is the founders are incentivized to go out and get not great investors because they know it triggers the match. I don't think that's beneficial to the founders of the startups in the long run. So you might then say, well, we're going to manage it. We're going to create a firewall between the studio team and the fund team, and those decisions will be made by different people. That's probably the best approach, but we've seen challenges around that too in the real world that pop up. So it's just difficult. What we decided is better for us to partner with others who can invest the capital, who are incentivized to do so. And so we're building a pretty good network of family offices and other investors to do that alongside us. Better if they're making the decisions, not us.
So you talk about future rounds like seed, Series A plus, or you talk about this initial investment to make company?
Future rounds, seed Series A plus. Yeah.
What do you think are some nuances or details venture studios should look at when partnering, when doing this corporation model, and partnering and creating external independent companies, but with corporations? What other studios might be missing when doing this? And what is the most important thing to focus while doing this?
Yeah, I think there's kind of two things studios need to watch out for. Number one is, what is the ultimate objective of the studio? What are you trying to do? If your goal is to work with corporations as a stepping stone or a means to an end of doing something else, for example, funding other studio operations or getting things going, what I would say is there are easier ways to achieve that outcome that you have in mind for the studio. Working with corporations to build ventures along the way is a massive distraction from what most venture studios are set up to do, and I'd strongly advise against it. Go find another way to fund the studio. Number two, I think a lot of studios underestimate just how hard it is to work with corporations to build new startups and to do it well. It's incredibly challenging. This is, my friend Clay Christensen wrote a book on this, The Innovator's Dilemma. It is a very, very hard problem to solve. These corporations are not designed to do this. And to go in and think that, casually, part-time while building other things, with a small team of people, you're going to go in and work with a corporation and be successful in launching new ventures is, you might get lucky, but it's a lot harder than that. Over time, over the last 3.5 years, we've scaled our team to be about 40 people now. And these are people who are world-class experts in corporate innovation theory and navigating executive boardrooms and strategy, as well as everything related to startups and fundraising and cap tables and test and learn and all the things you do in early stage businesses. It's kind of a unique combination of skill sets. You really do need both. It's two different languages, and in many ways I view our team as translators between the two. I think a lot of venture studios assume that you can go into a corporation speaking fluent startup ease and work with executives effectively to pull off what you want to do. It's really hard. I think a lot of studios underestimate how challenging it really is and the trade-offs that come. We've built our business model purposely and optimized it for launching startups with corporations. And we've made some deliberate decisions about the way that we're set up and the way that we work to do that I think you'd be compromising in a lot of ways if we weren't set up that way.
Can you maybe tell a bit about your model of how you start a company, how you validate ideas, and how you get first revenue, fundraise? Do you call it Playbook?
We do call it our playbook. Yeah, on the surface level, the stages aren't too different from what most venture studios would do. I think where you see a lot of difference between studios is where they snap the tape and say, now this is a new venture that's been launched. We've incorporated something. We tend to incorporate relatively early compared to where some other studios might incubate things inside the studio for longer. What we've learned is that we want to push these things into new entities with well-incentivized world-class founders as quickly as we have enough confidence to do so, because they can generally move faster than even we can inside the studio if we're incubating internally. So our processes are... think about it, there's kind of two sides to our business. There's everything that happens prior to a launch decision, everything that happens after a launch decision. The upfront process, we're going through early problem identification. Typically that involves aligning with our corporate or university partner around a broad theme. Within that theme, we will then go identify who are all the possible customers, what problems do they need to have solved, or what are their jobs to be done, is the language we use. What enabling technologies or business models might we use to address those problems? The combination of a customer, a job to be done, and an enabling technology or business model is what we call a strategic opportunity area. Within those strategic opportunity areas, we can ideate, generate dozens or more potential business ideas initially, and that becomes our initial set. So if we work with a corporation, we identify a theme, within a couple of weeks, it's not unusual to generate 200 or 300 business ideas using that structured approach. Now, these are early. They're just nuggets of an idea. We'll then do some quick assessment of those ideas, look at what's the big assumption that would need to be true for that idea to be successful. And we'll do some rapid testing over a few weeks and take that list of 200 ideas down to maybe 30 that warrant a deeper look. And then we'll move those 30 to more extensive testing, which looks like a lot of customer conversations and other forms of research, environment scans, looking at who else is launching businesses in the space, how are they approaching it, who's raising capital, what do other people believe about what's going on in that space. From that list of 30, maybe we'll get it down to 5 to 10 that kind of make it through our process of validation, where we've got at that point a hypothesis business model. So what's the product or service? How does it make money? How do we deliver that product or service? Make it, what's the value? In other words, what's the value prop, the profit formula, and the delivery model for that business. Once we've got the hypothesis, we'll select maybe 2 or 3 of those to run through, of the 10, to run through what we call our sprint week, which is our forcing function for launching new businesses, both at high alpha and high alpha innovation. And in our sprint weeks, over the course of 4 days, we'll take a pretty strong hypothesis about a business that's gone through a lot of customer validation already and get that business ready for launch. So sometimes we'll go into a sprint week with a few questions we still need to answer. Sometimes it's maybe we need more customer validation and more customers to be ready to pay for the business when it launches. At the end of the week, we make a pitch, and we're now ready to make a decision about whether or not to launch that business. Post sprint week, we'll usually spend a couple of weeks putting together a memo. If the sprint week and the pitch, that sprint week is pretty rah-rah, exciting. You look at all the pitches coming out sprint week, and they all seem like good businesses to launch. Of course, we know where all the flaws are in the model. And so we'll spend a couple of weeks doing a more objective analysis of the reasons to invest or to not invest, come back with our corporate or university partner at the end of that and make a firm decision about whether or not to launch. And so that's everything that happens pre-launch decision. That's our process. Once we decide to launch a business, there's a whole other side of that. That's really when things start.
So when you incorporate, you get money from corporations, usually.
Usually, the corporation or the university is making the investment. Now, there's some nuance to that. Sometimes we'll invite other investors to participate right from the launch, but generally, the corporation or university we're working with is not keen to bring other investors in at that point because, boy, those returns for those who are in right at the beginning can be pretty good when a business works. But one of the things that we've done over time as our model has evolved, Max, is that when we work with corporations or universities, we may go launch a handful of businesses with them over time. At some point, it becomes more efficient to just pull together a fund and create a new studio in partnership. That's what we're doing now with several of our partners, where we're creating a fund, $25 to $50 million, in which we're the general partner operating a studio under that fund. And there are different structures we use to do that. Each of them is a little bit different. But in those cases, the investment into the startups comes out of the funds that we manage. And those funds can be provided by the corporate university partners. Sometimes by a case of university, it might be alumni, other investors, or it might be even corporations that are pooling their resources to fund a studio that benefits all of them.
Venture Studio High Alpha launched High Alpha Innovation, a studio working with corporations. And then now High Alpha Innovations launch new studios.
Yeah, it's very meta, isn't it? If you think about a typical venture studio, we've tried different approaches to this at High Alpha over the years. I think the most we ever did in 1 year was 11 or 12 startups. That's a lot. Generally, a well-functioning studio is going to launch 4 or 5 companies a year. One of the questions we wanted to answer with the launch of High Alpha Innovation was, what does it look like to scale a studio model? In my view, venture capital broadly and venture studios you're playing with a power law asset class. And we know when you're dealing with power laws, the way to win is to have a very broad and diversified portfolio to make sure that you trip into those 1 or 2 things that are going to create most of the returns. That's hard to do when you're only launching 4 or 5 companies a year. Now, I think a well-managed venture studio can shift the power law curve, right? You can expand that out and you can achieve success with a smaller portfolio than you need in venture capital. I think that's true. However, I think your chances of achieving success are greater the bigger and more widely distributed your portfolio is. And so as a result, we launched High Alpha Innovation. One of the questions we were trying to answer, what does it look like to scale a venture studio model? We can launch 4 or 5 companies a year in one studio. What would need to be true to launch 100 companies a year successfully? And well, the answer to that is, based on what we know right now, is we need to launch a bunch of other studios with partners, accessing more capital, ideas, deeper level of understanding of the problems we're solving. If we can build a bunch of studios that are each launching 4 to 5 companies a year, that's how you get to 100 launches a year.
When you started this approach, and did you already launch a fund for some studio of a corporation?
No. That was always the goal, to get to that eventually, and it's fun now in our 3rd year to be doing that and executing on the original plan.
In terms of attracting founders, are there differences in the ideal co-founder profiles when they know that it's a startup backed by a corporation? Probably they will have a bit less control in terms of doing their decisions in a company?
It's a little bit different. I don't know all the details of your background, Max, but my background is I've started companies where, just a friend and I went out and started something, and we were 100% owners in the business. We didn't have a board. We made all the decisions. Boy, in the right circumstances, that's an amazing way to do it. In other circumstances, it does make sense to have a corporation there in the beginning, to set up a formal board. Usually we're launching with a board of 3 people, corporation or university or other investor representative alongside the CEO and someone, either an independent board member or someone from High Alpha Innovation involved. In those instances, again, there are trade-offs. You're trading some deference to a board and their decision rights in exchange for having a corporation and a whole bunch of capital on the cap table right at the beginning, and all the support of a studio and all the stuff that comes with that. I think in terms of the founders we recruit, our founders are amazing. We haven't done this officially, but I think our average age of our founders is probably 45, Most of them have been in successful startups before, either as the founder or an early executive. They have experience fundraising, building product, building teams, generally pretty experienced. And they look at this approach as a way to move faster than they could on their own, having done it before many times the traditional way. This is a way to move faster, to get to bigger outcomes more quickly than they could otherwise. And they're pretty knowledgeable, very, very experienced.
One of the last questions is about, can you tell a bit about disruptions theory to launch startups? So you mentioned it in your probably website and on your page, that like, what are key principles for this?
Yeah, disruption theory influences everything we do, the way that we think about building startups and working with our partners. I'll forever be grateful to Clayton Christensen, all the good work he did on this, and the opportunity I had to work in his universe for a little while. An amazing person, an amazing thinker. Disruption theory, what it says is that companies can do everything right, and ultimately they're destined to fail. And what I mean by that is a large corporation, what it wants to do is maximize profits. It maximizes profits by better serving its best customers. Better serves its best customers by moving up market, by creating more elaborate, complicated products and services over time. And what happens is that those services and products at some point overshoot the needs of many of their customers. And so that leaves an opening for new entrants to come into the market with a product or service that is lower end, good enough solution for those customers that are otherwise overserved. Those new entrants get a foothold and move up market, eventually displace the large corporation. Now, there are lessons in that. Once you see that theory, that model, you start to see it playing out everywhere. Corporations, it's a really hard problem to solve because they are designed to maximize profit. Everything they want to do is to serve those customers better and better. They're marching toward failure by leaving themselves open to disruption. We believe that startups are a fantastic way for them to plug some of those holes and to participate in the new market entrants that would otherwise come in and disrupt them over time. What's interesting is for the startups, the lessons for startups and for studios and for venture builders of any type is that you can use that theory to your advantage in the way that you design business models. And in particular, we often look for opportunities where there's a lot of non-consumption, meaning the existing products and services are more than most people or a lot of people need or want. It means that we're looking for ventures, at least initially, where we can go into a niche market and achieve pretty close to monopoly status in that very small niche. We're far less concerned about the eventual TAM. We're much more concerned about our ability to get a good, strong foothold with an initial set of customers, knowing that over time we'll be able to expand from there. So I think a lot of studios, a lot of venture builders, entrepreneurs make the mistake of this is a $7.8 billion market and we're going to go in and claim it. Well, the reality is you probably don't want to launch a company in a $7.8 billion market because there's a lot of other people in that space. What you want to do is the old Peter Thiel quote, competition is for losers. Which means you want to find spaces where you're competing along different performance dimensions, or identifying non-consumers that the large competitors just don't care about and will leave you to it. So that theory, a couple of ways where that theory influences the way we think about business model design, but it influences us heavily in every way that we build new companies.
Find a beachhead market and take monopoly there, and then join adjacent markets.
Expand from there. Yeah. The last thing we want to do is go compete against a big entrenched player initially. We want to find a hidden corner where we can go win and then grow from there, even if it takes time.
Thank you, Elliott. Maybe I didn't ask something you think might be important for venture studios around the world?
Yeah, we've done a fair amount of study of venture studios and different approaches too. Probably not as deeply as you have. I appreciate all the work you're doing to look at different models. Congratulations to you on that. It's good. I'm glad you're doing it because the world needs it. What we've seen is there are a few failure modes that are pretty common in venture studios. When you look at now, some people are counting more than 800 venture studios around the world at this point. It's a very long tail. Very few of those studios are going to be successful, unfortunately. I wish they all would be, but just like we see in venture capital or startups, power law distribution, it's a very, very long tail of performance. The reason, the common failure modes in studios that we see and that you need to design around to avoid are number one, not enough capital. Where you've got people trying to launch a studio and then raising capital for each venture one at a time. The problem with that approach is that you end up launching, in many cases, sequentially. It becomes this just this crazy cycle. For venture studios to work effectively, again, to get power laws you've got to launch a lot of ventures at the same time. You've got to have a bunch at different stages of the process at any given moment. And if you're trying to raise for each new venture as they come off one at a time, it just becomes really, really challenging to get to scale. Now, many studios begin with the idea that we'll do this for a while, prove what we're doing, and then go out and raise a fund. Well, then you're in a mode where you're raising for your startups and trying to raise a fund that some pulled off. It's really, really hard. That's a very common failure mode. The other failure mode is an opposite version of the problem, and that's where the portfolio scales and the complexity just expands geometrically. And all of a sudden, you have the founders of the studio who are sitting on too many boards and trying to manage a portfolio and do all these things while also launching companies, and they find that launching more companies becomes really, really difficult. When we launched High Alpha Innovation, we had both of those challenges in mind and designed our model to avoid both of those common pitfalls. But those, I think, are the two primary failure modes we see in studios, why they don't make it right out of the gates. The best studios are the studios, the best performing studios are the studios that are run by people with pretty deep operating experience and investment experience in some cases, where they can begin with a fund with funds under management to support the studio and the new co's coming out of it.
You think it might be that like a studio starts without a fund, working for 2 years, proving that their startups can be evaluated by the market fairly and that they can really build compatible startups, and then raise a fund? Do you think it's a good model?
I don't think it's a good model. I think it's possible. And in some cases, it's the only way people can do it, so go for it. If you look at the data, we've seen very few studios make the leap from that model to funds under management, doing it at scale successfully. Very, very few. In fact, I'm not sure off the top of my head I can even name one. I bet if I thought about it, I probably could. But every single successful studio that I've seen began with a pretty significant pool of capital at the beginning, well capitalized from the beginning. Yeah, right. So it may be that it's just early. We haven't seen enough cross the chasm yet, and we will. But if you go with the data on what's worked so far, that approach has not been successful broadly yet.
If you don't have this fund and want to launch multiple companies simultaneously,
go for it, right? Well, if every entrepreneur looked at the stats, nobody would start new companies.
maybe. So, the second idea you say, like, what is the failure?
Studios become victims of their own success. The complexity just grows.
Complexity.
It's just hard to manage, and it's exhausting, right? If you're not putting in place the right.
You have to have some model of increasing the amount of team to be able to launch several companies every year.
To a point. I think what's more important is to have absolute clarity around what the relationship is going to be between the studio and the startups that come out. Meaning very, very clear understanding with the founders you're working with around what studio is going to do and not do. It becomes an expectations management process that matters a lot. For example, how long are you going to support the companies coming out? What exactly and in which ways? Are you going to take a board seat every time or no? You do the math. Does what you're promising scale? When you've got 10 companies in the portfolio, what about when you've got 30 companies in the portfolio? You may find that you get in trouble, and tell founders all the time, do what doesn't scale. It's fine. You're learning, experimenting. Well, in a studio, sometimes it's hard over time to change the model and the way that you engage with those startups in your portfolio, and setting those rules up front with the end in mind is pretty important.
Thank you very much, Elliott. This was wonderful. I was very happy that you shared a story how to partner with corporations using a venture studio model. Thank you very much.
Yeah, appreciate the opportunity. It's fun to chat.